Hi there, and thanks for joining us here at PhillipCapital Market Watch. I'm Mooris, investment analyst from Phillip Futures. Today, we'll be covering a statistic that has been moving markets recently: inflation. Equities have seen some turmoil as April's inflation data came in higher than expected, but can we expect the trend to continue? Inflation at the beginning of the year started at plus 0.7%, well within the tolerances of Fed Chairman Jerome Powell's flexible target rate of around or slightly above plus 2% inflation. However, as some of you may know, April's year-on-year inflation came in at 4.2%, above analyst expectations. Also important, the month-on-month inflation growth rate also came in higher than expectations, and since then has caused some turmoil in equities, particularly growth stocks and those with higher valuations. The Federal Reserve has since come out to play down inflation concerns, as they expect the inflation rate for these 2 years to average out at around 2% at most. This essentially means that they do not plan to raise rates anytime soon, even in the face of April's surprising inflation data, which is a potentially reassuring sign for equities at the moment. If we take a closer look at April's inflation readings, however, an important component of the extraordinarily large year-on-year movement was likely due to the outsized contribution of energy inflation. Some of us will remember oil prices turned negative in April 2020. Oil prices in general for the month of April actually came in much lower than average thanks to that period, and thus has formed an incredibly low base, skewing year-on-year energy inflation prices upwards for April this year. Thus, investors should be able to discount some of the abnormally high inflation readings on a year-on-year basis due to this phenomenon. Looking ahead, oil prices in May 2020 also came in quite low, setting up a repeat, albeit less intense, of energy prices contributing to high year-on-year inflation. Food and non-food item inflation were more manageable, coming in between 2 to 3%. Looking at a key contributor to inflation, commodities rallied earlier this month to all-time highs across the board. The chart is a Bloomberg index tracking commodity prices, and in the top right, you can see that commodity prices have somewhat retreated from their all-time highs. This is contributed by reasons such as various economies scaling back their usage of commodities due to the all-time high prices, as well as jurisdictions such as China officially taking on high commodity prices themselves by curbing speculative activity and increasing supply. As commodities decline from their all-time highs, we can expect inflationary pressures to ease from their relentless rise. Looking at other related causes of inflation, we can see that the pandemic has fundamentally shifted US spending patterns. After spiking to all-time highs last year, the US savings rate remains stubbornly high despite some measures of household income already returning to pre-pandemic levels. While the immediate observation is that people are spending less and saving more, it actually remains an open question whether they will actually spend more the moment pandemic restrictions lift. Some restrictions, such as on dining out and domestic travel, have already been lifted in many parts of the country, and we are not really seeing the massive surge in consumption play out in the savings rate thus far. This could be because that the structure and behavior of consumer spending in the USA has changed through developments such as e-commerce and working from home. Hence, the US economy may enter a new phase of elevated savings rates, even if pandemic restrictions are lifted. To support this view, we can look at the velocity of money. Note that the officially calculated velocity of money is at its lowest level ever. Simply explained, what this means is that the effect of every dollar that the US government spends to stimulate the economy is at its weakest level ever, and further government spending is unlikely to spur consumption in the economy. In fact, taking reference to the previous slide, it is more likely that consumers will save or invest that money instead, both being activities that will not spur consumption and thus fail to contribute to the GDP. Another interesting observation from this chart is that the velocity of money has been steadily falling over the years, meaning that the US government's toolkit for spurring consumption is also potentially entering a new phase, one where it doesn't really work. Taking into account all these factors, I'm of the opinion that in the near term, elevated inflation is unlikely. Deflationary pressures remain strong as supported by the reduced spending we are seeing among US households. Looking ahead, however, medium-term inflationary pressures are likely yet to have come into play. For instance, should the USA conclude its vaccination program before the end of the year by achieving herd immunity, a full economic reopening will be on the cards. Will consumers spend more then? Will it be enough to return to pre-pandemic levels of spending? Furthermore, the latest job numbers on both the employers and unemployed show that both job vacancies and the number of unemployed people are remaining stubbornly high. Thus, evidence is building that salaries in the USA will have to rise to convince more people to return to the workforce, invariably raising our inflation outlook further. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Also, do tell us what you think by leaving a comment below. Thanks for joining us and see you soon.